How to model volatility skew. Have you ever wondered why options with different strike prices have varying implied volatility? This phenomenon is known as volatility skew, and it plays a significant role in options trading. Understanding how to model volatility skew can give you an edge in the market. Let's break it down step by step. Volatility skew refers to the difference in implied volatility between options that have different strike prices but share the same expiration date. Implied volatility indicates how much the market expects the price of the underlying stock to change. This is crucial for traders because it reflects market sentiment about future price movements. To model volatility skew, you need to gather implied volatility values for options across a range of strike prices. This typically involves comparing out-of-the-money puts and calls, as well as at-the-money options. Out-of-the-money options are those with strike prices above the current stock price for calls and below the current stock price for puts. At-the-money options have strike prices close to the current stock price. A common formula to quantify volatility skew is straightforward. You subtract the implied volatility of the out-of-the-money call from the implied volatility of the out-of-the-money put. For example, if the implied volatility of an out-of-the-money put is 20% and that of an out-of-the-money call is 15%, the volatility skew would be 5%. This positive skew indicates that traders are more concerned about downside risk and are willing to pay more for put options. There are several practical ways to model volatility skew. First, you can visualize the data by plotting implied volatility against strike prices for a specific expiration date. This creates a curve, often referred to as the volatility smile or skew curve. The curve illustrates how implied volatility changes as you move away from the at-the-money strike. Another approach is to use statistical models to fit a curve to the implied volatility data. Common models include the stochastic alpha-beta rho model and the Heston model. These models assist traders in understanding and predicting how volatility skew might evolve over time. Empirical analysis is also useful. By observing historical volatility skew patterns for a specific stock or index, traders can identify typical skew behavior. This can help spot anomalies that may present trading opportunities. In options trading, understanding volatility skew can inform your trading strategies. If the skew is steep, meaning out-of-the-money puts have much higher implied volatility than out-of-the-money calls, it may signal that the market is worried about a price drop. Traders might adjust their strategies to account for this increased downside risk, such as buying put options or selling call options. Modeling volatility skew also aids in accurately pricing options. Since options prices are influenced by implied volatility, knowing how skew affects volatility across different strikes allows traders to identify mispricings and potential arbitrage opportunities. To model volatility skew effectively, follow these steps. Collect implied volatility data for options across a range of strike prices with the same expiration. Plot the data to visualize the skew curve. Apply statistical models to fit and analyze the curve if you wish. Finally, interpret the skew to gauge market sentiment and adjust your trading strategies accordingly. Mastering the modeling of volatility skew is an essential part of options Greeks and pricing. It helps traders make informed decisions based on market expectations and risk, ultimately improving their trading outcomes.